Congratulations on your purchase of the Moore Stephens Lease Toolkit. This video is designed to assist in using the Lease Toolkit that you've purchased, and we'll go through 8 examples. 6 examples will be for a June year end, and then we'll use 2 further examples for a December year end. This will enable you to use it for different year ends. The first 6 examples will also have a crossover between the transition model and the calculator model to show you how they interact. After each example, I'll let you know when you should pause this recording so that you can then go and input the example into your own spreadsheet. I'll then show you how it should look and some of the pitfalls or some of the areas to avoid to make sure that you're using the toolkit correctly. So the first example, or the first client, has 6 examples. So all of the following 6 examples should be put into the same client spreadsheet, and we'll use a 10 lease spreadsheet just for ease of use, given that there are only 6 leases to put in. This client has a June year end, and you're going to be preparing entries for 30 June 2019, 2020 and 2021. We'll assume there's an incremental borrowing rate of 6%. They only transition at the mandatory dates, and they have historical information up to 2018. And they plan to use transition option 2 for all leases. So the first thing I'd like you to do is to go and set up the time series tab in the lease transition model. So please pause this video and then go and set up the time series tab. Okay, so this is the time series tab in the at market lease transition tool. Your client was a June year end, so therefore you should have set the financial year end in row 11 to June. The next 2 rows are the earliest lease start date month and the latest lease end date month. These have been preset in the model to 2010 and 2040. Provided your leases start after 2010 and end prior to 2040, there's no need for you to actually change row 13 or row 15. If you do decide to change these rows, then they must only cover a 30-year period. For instance, if you change 2010 to 2005, that would then restrict the end date to 2035. We can customize models over larger date periods. Please contact us if you need a model that ranges more than 30 years. The denomination you can set there between dollars, thousands, millions, billions. And the transition year for a June year end transitioning at the mandatory date will be 2020. So IFRS 16 or AASB 16 commences 1 January 2019. So for a June year end, that will be 30 June 2020. The start of that year will be 1 July 2019, but the transition year in the model works off the end date of that financial year. So in this case, it will be 2020. The information provided said that you had historical information up to 2018. It's very important that the last historical month is set in the last month of any given financial year. So for a June year end, you should set the last historical month to June. Given that you only had information to 2018, you would set that month to June 2018. Next year, you could set that to June 2019 if you have that information, but the historical month should never be in the actual year that you're transitioning. So it can't go beyond June 2019. It could go earlier, June 2017, June 2016, but they're the restrictions of the model. So now that you've set up the time series tab, you're ready to start to put in some leases. And here is the first lease example that I would like you to put in. It's a 5-year lease with a 5-year option period. monthly payments of $5,000 in advance, and the model assumes all payments are in advance in any case. It commences on 1 July 2015. There's a fixed annual increase of 4%, and the client is virtually certain of taking up the option period. Once again, please pause this recording and go and input example 1 into the correct spreadsheet. So example 1 should be put here in row 15 under lease 1. So lease 1, you can customise that name. You can put street addresses, equipment numbers, registration numbers. I advise that you actually do write a relevant name so that you know what that is. You can see there that the start date commences 1 July 2015. You had a term of 60 months. I will come back to the per month payment because that's an area that you may have got incorrect. There's a fixed annual increase of 4%. The increased month is locked on the anniversary date. There was no fit out, no useful life, no make good, and an incremental borrowing rate of 6%, no rent-free periods, and an option period of 60 months that you're virtually certain of. Now, this lease started on 1 July 2015, and you said that you had historical payments up to 30 June 2018, which means the model is looking for historical payments. Now, the historical payments work off financial years. So the lease started on 1 July 2015, which means 2016 financial year is the first year of historical payments. And that $5,000 represents the payment in June 2016. So it's the last month of that historical year. The payment went up by 4% in 2017. So in June 2017, the payment was $5,200. In June 2018, the payment went up another 4%, $5,408. And in the lease assumptions tab, the per month payment is for July 2018. So if we go back to the time series, you had historical information up to June 2018. The lease assumption works off the very first month after that historical payment. So in July 2018, remembering that you had an increase because the increased month is in July of 4%. So it went up 4% basically when you compare it to that historical payment. So in June 2018, it was 5,408. In July 2018 was when the increase occurred. You need to put that number in. And that is the most common mistake, is just getting the historical payments and the correct per month payments. Now that you have all those in, if you flicked over here to the analysis page of the option analysis, you should have this sort of information under option 1, 2, and 3 for your first lease. And you also should have the year-end numbers coming through as well. So let's, now that you've learned from that first example, let's input the second example. Once again, please pause this video, take time to go and put that example into your spreadsheet. Okay, so the second example, once again, we've called this lease 2, commences on the same date, 1 July 2015, has a 5-year initial term at $6,000 per month with no increase, no fit outs, no make goods, same borrowing rates, but there was a 6-month rent-free period that needed to be input, and the option period that was put in was 0. Now, the reason it was put in as 0 is that it was stated here that the client is more likely than not of taking up the option period. Under the accounting standards, you need to be reasonably certain of taking up the option period before it's included in the model. So don't include all option periods, only those that you're reasonably certain of taking up. So therefore, we've left that at 0. And we also need to input the historical payments. So the historical payments need to go in there. There is no increase, so they're just merely $6,000 at each financial year. Just to recap, that's what you should have there for lease 2. And if you go to the option analysis tab, you should have the same numbers there for lease 2 as well. Let's have a look at example 3. Please pause the video and input example 3 into your spreadsheet. Okay, here is example 3. Commenced at an earlier date, 1 July 2013. It was a 10-year lease. It had fixed increases, so we'll come back to this number. You may or may not have got that number correct. The increase month is in July again. It had a fit out of $40,000, which had a useful life of 8 years, so it had a different useful life to the lease term. It also had a make good of $50,000, and you'll input the borrowing rate of 6%. So the lease commenced 1 July 13, which means the first financial year of historical payments should be 2014. And you can see that's there. So it commenced at 8,000 and increased by 4% each year along there, because they're all June numbers. So June 2014, June 2015, June 2016, up to June 2018. And then the 9,359 also increased because it increased in that July month. So therefore, that needs to have gone up by 4% as well. And if you've input all those correctly, you should therefore have these numbers for lease 3 for your option analysis, and these numbers across here for your balance sheet at the end of the financial years. Let's have a look at example 4. So example 4 is a 10-year lease, monthly payments of $4,000 starting 1 July 18, subject to market rent reviews every 2 years. And we'll use this information when we get further down. Obviously, they didn't know this at 1 July 2018, but on 1 July 2020, the market rent review went to $4,500. So pause this video and input that into your spreadsheet. So let's have a look at lease 4. Commenced 1 July 2018. Now, you have historical information up to 30 June 2018, which means if you go to the historical payment tab, there is no historical payment information for lease 4. 10-year lease, 120 months, $4,000 per month. Now, the standard says you do not predict market rent reviews. You only deal with them when they actually occur. So as at 1 July 2018, all the way up to 30 June 2020, you have not had any new information on the market rent reviews. You don't predict it. You haven't made any payments. You leave it at 4,000. Everything else is basically blank in this, and it's got a 6% incremental borrowing rate. Now, when you go to the option analysis tab, what you'll notice is that option 1 has no transitional entries, because option 1 transitions any leases that existed on the transition date. So this is a new lease that commenced on that 1 July 18. It doesn't have any transition journal entries. It still has transition journal entries for option 2 and 3 because they're 1 year later. If you look here at the transition date, they're 1 July 19, as opposed to option 1, which is 1 July 18. But this lease will come into your closing balance sheet. So the spreadsheet can tell the actual starting date of the leases and whether there needs to be a transition journal entry. But you'll see here that there are closing figures in the income statement and balance sheet for that lease under option 1, even though there were no transition entries. Let's have a look at example 5. 10-year lease, payments of $4,000, commenced 1 July 2019, subject to CPI increases, and the CPI index went from 100 to 102 on 1 July 2020. Similar to market-based reviews, you do not predict CPI. It's only when the payments change as a result of CPI that you then recalculate. So pause this video and input example 5 into your spreadsheet. Here's example 5, commences 1 July 2019, 10-year lease, payments of $4,000. As I said, you don't predict CPI, so you don't put an increase in, you don't put new payments in until they occur, and we've got an incremental borrowing rate. Once again, there are no historical payments because it commenced after our last historical payment information. And if you go to the option analysis tab, you'll see because it started on 1 July 2019, it's actually post all of the transition options. So there are no transitional journal entries. There's no 2019 comparative information because it started after that, but there is information at year end for 30 June 2020. And the results are the same under option 1, 2, and 3 because there was no transitions. We then move on to example 6. And example 6 commences 1 July 2020. So this is post your transitional period. Your transition for this June year end was 30 June 2020. This is a new lease post that transition. So now what I'd like you to do is to attempt to roll over the 5 previous leases from the transition model into the calculator model, and also to input this new lease that commenced post-transition. So pause this video. As I said, attempt to roll over your transition journals into the calculator spreadsheet and to add a new lease. So this is now your lease calculator model. And the first thing you need to set up is the time series. The time series should have the same transition year as your transition spreadsheet. So in this case, it was 2020. It has the same financial year end of June, and the latest lease end date is the same as the previous spreadsheet at 2040 with the same denomination. The last historical month, however, has now moved to June 2020. So we're assuming here that we are now doing journal entries, or we're doing the financial year end 30 June 2021. Once again, the historical months have to be the last month of the financial year, and they can't be in the actual year. So because it's the 30 June 2021, we've set the last historical month to June 2020. Historical lease assumptions should remain blank in the first year. So 2019 and 2020, you can actually hide. They will be brought over as part of the rolling of the transition model into this model. Post 2021 is when you use the historical lease assumptions to roll this into 2022. And I'll be preparing a separate video on that closer to the time to show you how to roll this model forward. Imported FS journals. You'll see down the side here that these are all collapsed. You can open these up and you'll see there that we've got 10 leases coming through. Now these are all formalised. The way to bring all this information through is to click Data, Edit Links, Change Source, and to make sure that you have linked your transition model. So you change the source, find the transition model in your directory, then close, and it will bring all that information through. What I'd like you to check is to see whether or not you have the same information there for 1 July 2019. That is all of the journals, all of the 5 examples coming through. Now, what you might find is that, in fact, you have some slightly different numbers. If you do, I'd like you to go back and to check your transition options. So in the first spreadsheet, it was stated that the client wanted to use option 2 for all leases. So you might find that some of your leases have option 3 or option 1. You do need to remember that under the standard, it's either option 1 for all leases, or you can pick and choose between option 2 and 3. In this example, we've picked them all at 2, but you could go lease by lease between option 2 and 3. So if you've got that correct and you've got all the other information correct on that screen, feel free to pause it and double check. You should have all that information. You should have all that historical payment information. And if you've done that and you've edited your links, you should end up with this final journal entry. And as I said, you can actually expand these boxes and you can see that the lease name comes through as well as the information being brought through about different items. The next very important issue that you need to see is that some of these cells are formalised. These are pre-transition lease assumptions. So this can bring through, because it's a 10 lease spreadsheet, can bring through up to 10 leases from your transition spreadsheet. It's formalised for the name to come through, formalised for the start date to come through, it's formalised for the term to come through. It hasn't been formalised for these areas, and I'll get back to that. It's formalised for the make good and the fit out. You need to input the incremental borrowing rate. You can link that yourself if you prefer to, and it's formalised to bring those through. So first of all, you need to make sure that you have the correct incremental borrowing rate, which we said was 6%. You need to make sure that you reflect the right annual increases. And then what you need to make sure is that these per month payments are for July 2020. So it's the first month in the financial year you're completing. So we are completing 30 June 2021. So these payments represent July 2020. Now, you can calculate these or you can link them. I've linked mine, and the way to link it is to go back to your transition model, go across to your calculations tab, expand out your different lease payments, and you'll see that here we've got payments and we're looking for this number here, July 2020. And that will give you the correct payments that you need to bring across into your calculator model. With the exception of these two, if you can remember that the facts told us that lease 4 was set subject to a market rent review. And the market rent review went to 4,500 on 1 July 2020. So we put in the new number. Lease 5 had a CPI increase. The index went from 100 to 102 in July 2021. We put in the new payment. So you update those cells. You then have the opportunity to put in new leases. And lease 6 was a new lease. Commenced 1 July 2020, 10-year lease, 10,000 per month, 4% increase, same incremental borrowing rate. So once you've done all that, you can click across to the FS Journals tab. And I would advise that you hide the first two columns, 2019 and 2020. They're just calculation tabs coming through from the previous spreadsheet and don't always represent the correct numbers. So hide those. And if you go up here, lease 1 shows you what it looks like in the income statement and balance sheet. And it shows you what the journal entries are for this year. Goes down the same for lease 2, lease 3, lease 4, lease 5. Now, there were several blanks because the first 10 leases in this FS Journals tab are for your 10 transition journals. So the new lease you've put in the post-transition, you need to scroll down a bit further. It starts basically as lease 11 in this example. And you can see here that this has brought in a new lease, income and balance sheet. It's brought in new journal entries. So it's created a right of use asset, lease liability, etc. for your new lease. What I did want to highlight is how the spreadsheet deals with market rent reviews and CPI. So lease 4 and lease 5, market-based rent reviews and CPI are effectively treated the same under the accounting standard in that you do not predict them, but you do adjust the payments once the payments are changed. So how the spreadsheet does that, if I use lease 4 as the example, so lease 4, the payments went from 4,000 to 4,500. We scroll up here to lease 4. And if we look here, the right of use asset has gone up. And in fact, the lease liability, we made payments of $54,000 during the period. We had interest expense of $19,610, which would have meant that we would have assumed that the lease liability would have had a debit of it to $34,390. But because the payments have gone from $4,000 a month to $4,500, the model has actually recalculated your lease liability. And the lease liability has actually gone up by $38,048. And so the model debits right of use asset, $38,048, credits lease liability, $38,048, but then obviously it reduces the lease liability for the difference in these payments as well. So that's a net figure. What that illustrates to you is that the model follows what the standard does, which is if your payments change for CPI or market-based reviews, you compare the old lease liability to the new lease liability, make that adjustment, and then debit your right of use asset. And you can see for lease 5, which had a CPI increase, that the same things happened, that it's adjusted the right of use asset and the lease liability. I think the other important thing to note is that it also, when you adjust the right of use asset, you need to adjust the depreciation. So if I went back to the transition spreadsheet and had a look at lease 4, you can see there that under option 2, the depreciation for the right of use asset is $36,029. Whereas in my calculator model, once I've increased the right of use asset, my depreciation has increased from that $36,029 to $40,785. So it's recalibrated your right of use asset as well so that it gets back to 0 in the final year. Okay, now what I would like you to do is to save those 2 spreadsheets, close them down, and I want you to now attempt to do this for a December year end. So open up a new transition. We're just going to work on the transition spreadsheet this time. So open up a new transition spreadsheet, and I want you to set up the time series for a December year end. We've got historical data to 2017, borrowing rate of 6%, and we're going to transition using option 2. Please pause the video and set up the time series. You'll see here that we've changed the financial year end to December. We haven't had to change the lease earliest start date or ending date. Our leases are within those boundaries. No need to change if you don't need to. But the transition year has changed because this standard kicks off 1 January 2019, which means for December year ends, they need to transition at 31 December 2019. So the transition year has changed. And we had historical information up to 2017. And the last historical month, it's very important that, once again, it is set in the last month of any financial year. So for a December year end, it needs to be set in December. And we only had information up to 2017. So we've set it at December 2017. I'd then like you to input these 2 examples. So please pause the video and input those 2 examples into your spreadsheet. Okay, so you should have input these 2 examples. This will be the area, once again, that you may have run into some issues. We will talk about where to get those numbers from. So start date 1 July 15 for both of these. They both had a 5-year term. One had a 4-year increase. They both had an incremental borrowing rate of 6%. We included the option period for the first lease because we were virtually certain, but we didn't include it for the second lease because we're only 50-50. We have included rent-free periods. Now, we've said that we had historical information up to 2017, December 2017. These leases commence 1 July 15, which means the spreadsheet is looking for historical payments for the financial year ending December 15. So our first piece of information is here in December 15. Now, they should be the monthly payments for December 15. Second lease is quite simple because there's no increases. But the first lease will be $5,000 the monthly payment in December 15. December 16, it's gone up by 4%. December 17, it's gone up by 4%. What you might note here is that the December 17, 5,408, is the same as the January 18. Remember, it's in the lease assumptions tab, it's the first month following your last historical month. Now, the annual increases of 4% only occur in the 7th month of the year, being July. So therefore, December 17 to January 18 has no difference. So the per monthly payment, 5,408, is the same as the closing payment. So if you've done that, then you should be able to go across to the option analysis tab and get these same figures for options 1, 2, and 3, for leases 1 and 2, and the same balance sheet. If you're ever looking for more information, please go into the calculations tab. You can expand all these different boxes and they will show you payments, etc. One of the things you should always check is if you're not sure if the payments are coming through correctly, actually look for the months and the payments and when you expect increases to occur. So in this case, we expect a July increase. That's when the spreadsheets come through with the right payment. So you can always double check with those. A couple of final points I'd like to make is don't forget the application date, 1 January 2019. So it's 31 December 2019 and rolling forward for different year ends. And this spreadsheet is only good as the inputs that go into it. So if it's got garbage put in, it's got garbage coming out. So you really need to take time to learn to understand the model, how it works, and to effectively dig into it to see if it's doing what you're expecting it to do. And if there's any questions, please remember to email us on our support email, and we're more than happy to assist you.